Good morning, my your valued CPA audience, viewers, and listeners out there. I'm so excited to be here with you this morning. And I'm going to ask you a question here. What if I told you that a 5-minute call to your CPA could save you thousands of dollars in taxes or even more? Today, we're diving into the 10 biggest financial decisions that could cost you way more if you make them first and ask questions later. So, one of my pet peeves is when a client comes up to me and says, I just. Those are my two worst words that I want to hear. I just. I just sold my home. I just started this business and I want to rip my hair out sometimes because if you would have called me before you made these huge decisions, then you could have saved a lot on taxes, a lot on heartache, a lot on stress, and we could have come up with a better plan. All right. So I'm going to break this down into two items. We're going to go into the CPA cheat code for business and personal items. Okay. So we're going to talk about business first, and you are the boss. You make boss moves. However, your boss moves do need a CPA check in. All right. So I want to go into these and I'll kind of, go into some details here. And when you walk away with this information, I want to make sure that you have a stronger relationship with your CPA. And I promise you, there are no stupid questions, there are no stupid ideas. However, the only stupid thing is if you don't ask the questions before you actually do them. All right. All right. So, one of the top business blunders is business entity structures. Okay. So, there's two things here. So, first of all, there is a huge difference between LLCs, S corporations, and C corporations. And there could be a difference in tax savings for you. And if you don't choose the right way, you might have a major tax bill. Okay. And each of those categories of entity structures also provide different rules that the IRS expects you to follow. So I don't want you to trip up over the details here, but just know that selecting an entity structure or creating a business is certainly something you need to talk to your CPA about before you actually do it so you can plan appropriately, not only for the top things that need to happen when you start your business, also your entity structure, and also the timing in which you start your business. Okay. And then another thing with creating a business, another pet peeve of mine, let me rephrase that, is let's say a calendar year ends, and we'll talk about 2024, right? A calendar year ends, and all business entities that are required to file a tax return need to file an extension or a tax return by either March 15th or April 15th of the following year, depending on what tax structure you're in or entity type that you chose, right? So sometimes clients think or people think that just because your business didn't have any activity, you don't need to file a tax return. And then come June or July, they tell me, oh, yeah, I started this business last year. And then the series of problems begins and it could potentially roll into a snowball. So make sure you discuss this with your CPA beforehand. Okay, next, buying or selling a business. Structuring your deal in the incorrect way can cost you more in taxes than you make in profits. I'm going to let that sink in. The wrong structure in buying or selling a business can cost you more in taxes over the long run. So there's different ways to purchase a business. Is it an asset purchase? Is it a stock purchase? Are you selling your assets? Are you selling your stock? What does that look like? There's basis considerations, there's timing considerations. Do you sell it all outright or do you create an installment sale? There's a lot of decisions here that are truly going to lead you over the next 3 to 5 years and will lead your tax situation. So we want to make sure you structure that correctly. All right. The next one in businesses is employees versus contractors. Okay. I'm going to give you a secret here. The IRS loves to audit businesses that get this wrong. Okay. Here's how to play it smart. Just because you don't want to pay payroll taxes is not a reason that you're going to have someone be an independent contractor as an employee. The IRS does not care about your opinion, whether you want to or don't want to pay your payroll taxes. They have a very strict rules on who's an employee versus who's a contractor. If you have an employee that you provide their tools to work, if you tell them how they need to do their job, if you tell them when and where and how they need to conduct themselves in the office or working at home or communicating with clients, guess what? They're employees. You're controlling their environment as an employer, you're allowed to do that, right? But know that when you do that, you're dealing with employees, not independent contractors. Think about it on the flip side. An independent contractor would be someone that can work anywhere they want to. They can conduct themselves however they want. They provide their own tools for work, meaning they have their own laptops, they have their own research materials, they have their own SOPs, they have their own deliverables. The only thing they need to know is what the outcome is. What are they being hired for? And I'll use myself as an example, right? If you hire your CPA, you're not hiring them to be your employee, right? You're hiring them to do a job, file my tax return, do my monthly accounting, done. We do it in our own way, in our own manner. We provide the deliverables, and it's more of a contractual relationship, right? These are the things that we need completed, says the business owner. And then that business owner interviews multiple contractors to see if they can meet that in a reasonable time frame, in a reasonable manner, in a reasonable reputation, so that they can get the result that they want. So contractors are results driven. They can work through things in any way they choose, right? As long as the project is completed. And employees, you control their environment. So this is a completely oversimplified way, but at the end of the day, the IRS knows that business owners prefer to pay individuals as independent contractors or businesses as independent contractors because they don't want to pay their payroll taxes. And they know that. And they know that, and they will audit you if there's a red flag that's raised and if you don't follow entity structure rules. Okay, so this all kind of flows together. All right, I won't belabor that topic. I'm going to move on to the next one. Big ticket purchases. Okay, the big question here is, should you write off your car, your office equipment, other physical assets? Should you do it now or later? All right. Your CPA will be able to guide you in that answer. So, one of the first questions I ask clients when they make a large purchase, right, is what's the plan for your business over the next 3 to 5 years? Do you need all the tax depreciation right now? Do you need the Section 179 right now? Do you need the bonus depreciation right now? And sometimes the answer is yes. There's no right or wrong answer here, but knowing more about your client's situation and what the business owner intends for themselves and for the business over the next 3 to 5 years is going to dictate how we depreciate the large assets that you purchase, right? So if you accelerate your depreciation and depreciate all of it now or the majority of the large ticket purchase at the moment, then you're accelerating your depreciation, right? You are lowering your profits because you're increasing your expenses. However, you won't have that depreciation, or you'll have much less of the depreciation in the future. And maybe in the future, you're looking to grow and you're going to have a larger amount of profits to be taxed on. Maybe you really need the write off in future years instead of the current year. So consider that. Also, I want to make you aware because I most clients are surprised when they don't understand how depreciation works, right? Let's say you purchased a large asset and you depreciated all of it or the majority of it in year one, and then you decide to sell it in year two or three. Guess what, my friends? You're going to have depreciation add back. And depreciation add back isn't fun because the IRS doesn't want you to double dip. So you can't take your depreciation and sell an item, and they don't want you to be able to benefit from both of those situations, right? So if you sell an item and you take all the depreciation in year one or the majority of depreciation in year one, what the IRS forces us to do is do a calculation of what it would have looked like if you straight line your depreciation over the asset's life, and then the difference between the acceleration and what it normally would have looked like if you didn't accelerate your asset. And that difference you're going to be paying taxes on. So, super, super simple thing to talk to your CPA about. And it makes a really big difference on your tax liability. Okay. All right. The next one is paying yourself. This is a huge conversation. Depending on your business entity structure, right? Your business entity structure is first and foremost going to dictate how you need to pay yourself as a shareholder, as an owner, and obviously, of course, your employees as well. But it more so dictates on how you're going to have to pay yourself as the business owner. So there's different options depending on what type of entity structure you're in. Are you going to pay yourself W-2 wages, salary, right? I don't want you to pay yourself too much, but also you can't pay yourself too little either. The IRS requests a reasonable compensation so that you're paying your Social Security and Medicare taxes. You're doing your proper federal and state withholdings as applicable to you and your role and your business and the entity type. So this can be complex, and there's a solution for it, right? For example, our office provides a reasonable compensation report where we will actually dive in, and based on your role and what you do in your business, what location you live in, what region, right? If you live in Florida versus California, rates of salaries are going to be much different, right? If you live in Tennessee versus New York, once again, rates of salaries are going to be much different. So it factors all these items to determine what is the minimum amount you need to pay yourself as a reasonable compensation so that you're not underpaying and making the IRS upset, or overpaying where you're paying too much in taxes. Okay, so that's certainly a decision. You can pay yourself in dividends. You can pay yourself in distributions, right? And each of them have different tax consequences. So, dividends, if you're in a C Corp, well, are you aware that there's qualified dividends and non-qualified dividends? So, paying yourself in dividends will also give you a different tax benefit. Did you also know that a business owner can pay themselves in distributions? Yes, distributions are tax free. However, they're only tax free up to the basis in your business. So, basis conversations are also really, really important to have so that your combination of distributions, dividends, salary, they can all be factored in into what your compensation package needs to look like so that you don't find yourself in trouble and you're not overpaying in taxes, but also at the same time so that you're meeting all the requirements for your entity structure, okay? So, if you're about to start or sell or spend or scale your business, we want to make sure that we're on your speed dial and you're asking the right questions. And if you're working with a great CPA that's already answering these questions for you, by all means, continue. And if you're not, then make sure you're working with someone that is able to help you and guide you through all these decisions. All right, I hope this business part helped. Now, on the personal side, I want to through some tax traps and money moves. All right. So this is super, super, super important as well. And once again, to recap, these conversations need to happen before you make the decision, not after. All right. Okay. So, for example, are you going to how are you going to factor in cash flow? All right. And we're going to look at cash flow from selling assets, stocks, crypto, real estate, right? Some assets that are going to create capital gains or capital losses. All right. If you sell too soon, meaning if you hold it for less than a year, there's a difference between short term and long term, right? So capital gains on short term is going to be your marginal income tax rate. Capital gains on long-term assets, meaning you held them for more than a year, 365 plus 1 day, that's a year or more, right? That will be long term. So in that case, you're paying reduced capital gains at 15%. And you may potentially pay more if you're in a higher AGI. And if that's the case, then we'd have to discuss some other tax strategies and to see, what your situation really looks like. But essentially, when you're selling stocks and crypto and real estate, you have to determine whether it's a short-term or long-term sale first and foremost. Okay. The other thing that we want to focus on is, do you already have some loss carryovers from prior years? Do you have capital loss carryovers that are short term? Do you have capital loss carryovers that are long term, right? If you do, you can potentially sell appreciated assets that would trigger capital gains, and your losses would offset those capital gains so that you would have a reduced tax liability. Another thing to consider here is your net operating losses. Your net operating losses, carryovers from prior years, they will also reduce your taxable capital gains. So all these factors are super, super important to factor in. And this goes with, stocks, crypto, and real estate. So you can harvest losses. Okay. You can also harvest gains. So these are conversations I want to make sure that you're thinking about, because if you harvest losses, right, when it comes time to sell, let's say you do own real estate, or let's say you're gonna hit it big with crypto, right? If you harvest your losses now, you'll be able to accumulate them. And when it's time to sell a really strong asset where you're going to get hit with capital gains because you made huge profits on it, those losses will be able to offset those capital gains. Also, on the flip side, you can also harvest gains, right? So if you know you're carrying loss carryovers, or you're carrying net operating loss carryovers, you can carry those forward into a year where you're going to sell something at a loss, or you're going to sell something at a loss, or you're going to sell something at a gain, right? So harvesting the gains are going to actually allow you to make a decision in a future year when you're ready during a cash flow period where
you can actually sell those appreciated assets and recognize that profit in a year where you have enough to offset it. So harvesting losses and or gains is a huge tax strategy move and can help you with your tax liability, but it has to be done correctly. Okay. And when you look at this, I want you to look at it from, or I encourage you to look at it from a 1, 3, and 5 year period so that you can make appropriate decisions with your next steps. The next is retirement plans, right? Sometimes it could be your retirement roulette. Do you put monies in your Roth or traditional? Can you withdraw monies before you're 59 and a half, right? One wrong move and your penalties can be extraordinarily significant, right? And the penalties can wipe out any appreciation or gains that you've received or any growth that you received in your retirement account. So the timing of this is super, super important because if you're 59 and below 59 and a half, you're going to be paying a 10% penalty on your withdrawals. Okay. And if you're over 59 and a half, at least you won't be paying the penalty. However, whether you're below or over 59 and a half, you're also going to be taxed at your marginal income tax rate for any withdrawals from traditional IRAs. For Roth IRAs, it's going to be tax free as long as you have basis in your retirement account. So these are conversations that are also there. This one, you're going to want to bring in your financial advisor as well and your CPA so that you can really see the impact of the assets that you're building up versus the taxability of the situation when you decide to either withdraw money or continue putting money into your retirement account. On the personal and business side, you can also use retirement accounts to defer income. All right. And this is also an important tool because when you defer income, you're essentially saying to the IRS that you're going to withdraw these monies in the future, so you're not going to be taxed on them right now. And then in the future, when you withdraw them, then that's where they're going to be taxed at a marginal income tax rate. So the question here is that I'm going to leave you with when, obviously, if you need the cash flow, you need the cash flow, right? Or if you're in a situation where you need the monies right now, it's kind of a different conversation in your decision making. However, what you want to consider is when will you be at the lowest marginal income tax rate? When will you have the highest income, highest AGI, highest adjusted gross income versus lowest, right? And sometimes if you have the ability to maneuver between years where you have higher or lower income, you can, if you have lower income, maybe you'll want to take more withdrawals from your retirement account and vice versa if you have the opposite situation. All right. So just know that that's a factor to think about and can certainly alter your tax situation. Another one is real estate regrets. One of the worst things I hate is I just sold my property. Oh, okay. Um, okay. Well, let's look at that. Let's unpack that, right? So if you just sold your primary residence, for example, and let's say you bought it a year and a half ago and you just sold it, okay? Are you aware that you just created a massive tax situation for yourself? This is what I want you to walk away with. If you walk away with nothing else, if you own your primary residence for 2 out of the last 5 years, the IRS gives you a $250,000 capital gains exclusion if you're single and a $500,000 capital gains exclusion if you're married filing joint. And this is incredible. But the caveat is that you have to live in your primary residence for 2 out of the last 5 years. Meaning, if you sell that property before that 2 years, in other words, before that 24 months is up, then you forego those capital gains exclusions and you can get hit with a lot of taxes there. So keep that in mind before you sell your real estate. Okay. And also, another thing here is when you sell your real estate, or actually throughout you owning your real estate, make sure you're tracking your basis. What does that mean? Make sure you're tracking all your improvements. Keep your receipts. We need to know the date and what was improved on your property. Did you put in a new patio? Did you put in a new roof, new fencing? Did you change out your HVAC? Did you change your plumbing or electricity? What have you done to improve the property? Have you cleared land? Have you built a new driveway, right? All these facets are going to increase the basis of your property so that when you sell it, right? We have proof to show the IRS and say, all right, we purchased the property for X amount of dollars. That's your cost basis. And we improved it in all these manners that I just mentioned. And of course, there's more. So now the combination of all of those increases your basis, which means it reduces your profitability margin. So I'll give you an example. If you sell your property for $500,000, right? And you purchased it for $300,000, but you made $100,000 of improvements, 300 plus 100 is 400,000 minus the 500,000 that you're selling it for. Now your capital gains are only $100,000 as opposed to $200,000 if you didn't include those improvements in your calculation. So when you're a first time real estate owner, whether it's commercial property or residential property, make sure you're tracking all the improvements that you have generated and created throughout you owning that specific property. Okay. The next, the next item is giving without gifting or gifting without giving, right? So there's a difference between donating to charities just because you want to donate versus transferring wealth to your family, to your children, right? So we want to make sure that we're maximizing those components so that you do them properly, okay? So when you're donating to charity, know that anytime you donate to charity, you have the ability to donate every single year. And when you donate, let's say you donate $100 or $10,000 or $100,000 to your charity of choice, you're able to write that off on your personal tax return on Schedule A. And your donations combined with any mortgage interest that you have, any real estate taxes that you have, any medical expenses that you have that are above 7.5% of your AGI, that combination will give you your full itemized deductions. Now, please note that the IRS only allows you to take itemized or standard deduction. If the standard deduction is higher than your itemized deductions combined, then you're not going to be able to use your itemized deductions. So make sure you look at that plan and plan for what you're going to be doing. And something that some of our clients use when they know that their standard deduction is higher than their itemized is that they stack their deductions every other year. So, for example, let's say someone donates $10,000 every year to charity, their favorite church or temple or 501c3. And but they know that when they do that, their standard deduction is still higher. So instead of, let's say, deducting or donating, excuse me, $10,000 in the 2024 tax year and $10,000 in the 2025 tax year, maybe they donate $20,000 in 2025 and nothing in 2024. I'm not suggesting that you need to do that, but I'm suggesting that that's a way where you can start the conversations of figuring out how to maximize your tax situation. Okay. So I really hope that helps. Also, gifting, right? Gifting is a really, really big deal. And the IRS provides different thresholds every single year to be able to gift to family and not have to pay taxes on it. All right. So in the 2024 tax year, you can give a gift of $18,000 and not have to file a gift tax return. All right. In 2025, it's $19,000. So that's very, very interesting. And I'll just share one example with you. Let's say you're a husband and wife and you have two kids, right? So for the 2025 tax year, because it's $19,000, you can actually give your child $38,000, meaning mother can write a check for $19,000 to child, father can write a $19,000 check to child. 19 plus 19 is $38,000. So see how that works because it's a gift per individual to individual. Okay. So look at that from all different perspectives because that's a way you can transfer wealth. Note that you can also do some strategic charitable giving with donor advised funds and qualified charitable distributions. Okay. So those are super, super important as well. But know that you kind of have to plan for these events so that you maximize your tax strategy and don't just do it willy nilly. All right. And then also, anytime you have a debt situation, talk to your CPA first. Cash flow is an issue, taxability is an issue, and writing off your interest is also an issue that need to be discussed here. So, for example, if you come across a significant amount of cash flow and you decide, hey, I want to pay off my entire mortgage, right? Or I want to pay off my entire loan, okay? Awesome, because now you're debt free. However, know that paying off the principal portion is not a tax deduction. So, for a business, for example, that has the interest expense deduction on the mortgage or the loan that you have, that interest is a tax deduction. The principal payment is not a tax deduction. However, both of those combined are cash outflow, right? Same if you're paying your personal mortgage. Your interest is a deduction on your Schedule A, not your principal. So if you pay off your entire mortgage, you might not have the ability to write off your mortgage interest because you don't have a mortgage by default. And note that that could potentially reduce your ability to write off items on your Schedule A. Because remember, Schedule A is a combination of your mortgage interest, real estate taxes, healthcare expenses, and charitable donations. So talk to your CPA first. Also, HELOCs. When you take out a HELOC, it has to be used for home improvements for you to be able to deduct your interest on your HELOC. Okay? So pay attention to that. Otherwise, if you use your HELOC to, let's say, invest in a business or invest in another opportunity, you can't write off that interest. You have to prove that there's home improvements on that HELOC there. All right. So I hope this helped with your big money moves and your big money moves decision. These top 10 items that I just discussed are super critical and will give you the opportunity and let's say the playing board, right? These are the playing pieces that you can maneuver around to make sure that you're aware and you have some sort of control with your cash flow, with paying taxes, and the ability to direct where your funds go. All right. So I hope this helped. I really, really, really look forward to seeing you next time. And I'm just going to leave you with this. Don't let Uncle Sam take more than he deserves. I want you to pay your taxes, but I want you to pay it in a smart way so that you're not overpaying on certain things that you could have had an incredible decision on. All right. And if you found these tips valuable, share this episode with a fellow entrepreneur or high income earner who needs to hear it. And if you want more tax saving strategies, hit that subscribe button because I've got more coming your way. And of course, I will leave you with this. Make sure you consult your tax strategist, your CPA, your enrolled agent, your tax advisor for your specific situation. And I am not giving you advice here. I am giving you the tools to make sure you are prepared and equipped to ask the right questions when you talk to your tax strategist. All right. I hope this helped. Bye.